Hello and welcome to this special show on banking sector earnings. I am Ankur Mishra and in next half an hour, we'll deep dive into banking's earnings so far. It's been a mixed bag so far for big banking names. While a handful of lenders are riding high on strong credit growth and stable profitability, many others are facing margin compression, rising slippages and elevated provisions. In short, margins are melting and slippages are swelling for a large section of the pack. So what lies ahead for the sector? Let's dive deep and decode the trends shaping India's banking story. And to begin with, I am joined by Varun Dubey, who has tracked the numbers closely and brings us a comprehensive roundup of the earnings so far. Varun, over to you.
Well, so it has been a quarter of actually weak credit growth, declining net interest margins, declining profitability, and also overall increase in the overall gross NPA numbers and increase in the provisioning and slippages for overall banking sector. Let me start with the big banks, that is Axis Bank, HDFC and ICICI. If you look, Axis Bank had its own problem of technical adjustment which had actually resulted in the overall deterioration of its asset quality, overall increase in the slippages and provisioning on a YY basis and on a quarter-on-quarter basis. But even though they had their own technical challenges, the overall profitability growth, there was a degrowth, and the PPOP that showed a growth of around 14%. If you look at HDFC Bank, even there we have seen increasing the overall provision and slippages for the bank. Though the bank has created a floating provision, but even if you exclude the floating provision, the overall provisioning and slippages of the bank has actually gone up. If you look at the overall slippages for the bank, that has gone up by around 13.9% on a YOY basis, and on a quarter-on-quarter basis, it increased by around 20%. Now, if you look at ICICI Bank, even though the bank has shown good double-digit growth in its NII, profit, PPOP, and also the advances and deposit growth were in double-digit, but for this bank also, the overall provisioning and slippages have actually increased. Though the overall asset quality, that is the gross NPA of ICICI Bank, remained stable, but even there, the overall provisioning and slippages has shown an increase. Now let's come to the smaller banks, that is the RBL Bank, Bandhan and the AU Small Finance Bank. If you look at here, the overall slippages have shown an increase from around 9% to around 89% to around doubling for some of the banks like Bandhan Bank. If you look in the overall provision, that has gone up by around 119% on a YOY basis, and also the overall slippages on a YOY basis that has gone up by around 1.7 times, and the same case is for RBL Bank and AU Small Finance Bank. But here you can see one more thing, and that is the overall growth. The overall loans and advances growth, they have slipped down to single digit. For Bandhan Bank, it has been 6%, RBL, it has been around 9%. But here there is one more point of concern, and that is the deterioration in the net interest margin. For Axis, HDFC, ICICI, we have seen the overall deterioration in the net interest margin was little less. But here if you see for this bank, the overall deterioration in net interest margin, that is up by around 27 basis point to 38 basis point. So it is more near to half a basis point deterioration in the net interest margin that we have seen. So for small banks, it is the deterioration in net interest margin, the increasing slippages and provision, and also the overall reduction in credit growth that has not been looked upon as nicely by many of the brokerage house. Now, if you look at the PSU banks, there the overall gross NPA numbers are far better because the deterioration in the NPAs was not much as when you compare it to some of the private banks. But over here, if you look, the overall NII growth, that has been a point of concern because for Union Bank, for Central Bank, if you look, the overall NII growth that has gone down from around 3 to 4%, and also the net interest margin, they have gone down. For provisions, the overall provision has increased on a YOY basis, has decreased on a YOY basis, but the slippages have increased on a YOY basis for Union Bank and Central Bank both. So if you sum up the whole banking sector in this quarter, it has been a quarter of slow growth. The net interest margin, they have declined for big banks, small banks, all, but the deterioration has been more for the small banks. The overall asset quality has actually reduced more for private banks. For PSU Bank, the asset quality has been better, but if you look across the banking sector, the overall credit growth has reduced, provisioning and slippages have increased.
All right, to sum up what Varun is saying, simply, credit growth is not as great as it used to be in last few quarters. provisioning is increasing and so as slippages. To make a sense of banking earnings, we have been joined by Shweta Daptardar as well as Aditya Shah. Welcome to ET Now. Before I come to you, let's also listen into ICICI and HDFC Bank management what they had to say on Q1 earnings.
The larger corporates are quite liquid, highly rated, and pretty strong on their balance sheet, which means the yield that one could get from that is lower. And we have seen competition from certain segments of the financial system where the rates are pretty low. They offer very low rates. And so consequently, while we like the quality, we have been selective in offering and waiting for the rates, that is at least the rates that the banks are offering to larger corporates to be stable.
We have got various segments which you have to meet the PSL requirement, and one of them is the small and marginal farmers, and we try to whatever meets our credit thresholds, we are happy to lend. I mean, so that is essentially what we look at. I think it's the first and most important thing is to ensure that the credit thresholds are irrespective of segment. So I would like to just make a distinction between that approach and rural. There has been a bit of a slowdown, which includes I think tightening of norms on the jewel loans also.
All right, so two big banks posted results on Saturday, and Shweta, I want to come to you for that. Before we begin our conversation, I want to know about HDFC as well as ICICI Bank earnings. While ICICI Bank has been picked by many as good earnings, what is your opinion on both the counters?
Yeah, hi, good afternoon. So we have seen increased provisions and slippages across the banking results. Also, the credit growth definitely is looking weakish and closer to just early double digits. So yeah, that is something will remain under radar for quite some time.
All right. Also, Aditya, I want to understand from you one underlying theme which has been this quarter for most of the banks, that credit growth is not as great as what it used to be in last few quarters, but provisions are rising. What is your take on this?
So, if you look at ICICI Bank commentary, you will see that uh, ICICI Bank is trying to stay away from areas where they feel underpricing of loans has happened, and also they want to protect themselves from future NPLs. So, from my perspective, the systemic loan growth will automatically pick up as rates continue to come down. So, I'm not too much worried about pushing of credit growth. RBI is maintaining liquidity within the system, as well as now interest rates have come down. So from my perspective, I would expect the larger banks to grow at only about 10 to 15%, not more than that really. They need to maintain asset quality, and for that, if they slow down the loan growth, that is better. Mind you, HDFC Bank does have a problem. That's why they have slowed down the loan growth to about 6%. And Shashidhar Jagdish and have said that they will slowly and steadily accelerate the loan growth. So from my perspective, loan growth will come, but it should not come at the cost of asset quality. Asset quality for ICICI Bank has remained stable. For HDFC Bank, it has seen slight deterioration. If you even if you take out the agri loan effect, which happens in Q1 of this year. So from my perspective, ICICI Bank's asset quality and loan growth is very acceptable and it's really very good. HDFC Bank slightly steady, but that will recover as time really goes on. From my perspective, the real problem is in the microfinance and in the unsecured side of the book, where a lot of NPAs are coming about and a lot of lenders are really struggling.
Aditya, this is Varun this side joining into the conversation. I just wanted to understand, when you say the credit growth will come back, how much time will it require to the overall credit growth to come back? And actually the overall less credit growth that we are seeing into the system, is it an impact of high base, or actually we are seeing a real slowdown into the economy which is actually hurting the overall credit growth? Might be the impact of microfinance or other sectors, overlapping the credit growth of banking system as well.
So unsecured side of the book has a real problem not only for smaller banks but for larger banks as well. Unsecured side, micro lending as well as credit cards all of those personal loans as well, all of those are seeing either they are seeing mispricing or they are seeing high, surge in NPS. So from my perspective, what you lenders are slowing down, prudent lenders are slowing down their loan growth there. Secured side of the book, I don't think I have heard any lender complain about secured side of the book. So from my perspective, as I said, if ICICI, HDFC, or an Axis grows at about 10 to 15%, I believe that is fair enough. I don't think there is going to be any acceleration above 10 to 15%, max 16%, 17%, not more than that really. I expect all of these lenders to, in the second half of this year, as the interest rate cut continues to bear down on consumers, they will start to get this loan growth back up. But I don't think the loan growth is really a problem. The real problem is within the asset quality. A lot of unsecured loans are turning out to be NPAs. Even if you look at the smaller banks, let's say Bandhan, RBL, or if you even look at as low as in an NBFC and HDB Financial, they are really suffering the brunt of lower quality borrowers defaulting. So asset quality is a major challenge for most of these banks. If asset quality continues to remain stable, a lower growth will also be accepted by the market in view of the asset quality. So asset quality concerns are the major concerns at this point, for at least for me, with respect to all of these lenders.
Uh, okay, that's great that asset quality will be a matter of concern for many of the banks. Aditya, you said that in majority of the big banks, you have not heard any asset quality deterioration. If you look at the big banks, there is an increasing provisioning and slippages. Axis had its own problem. HDFC, the reason was different because of the floating provision that they created. But even in ICICI Bank, we have seen the overall provisioning and slippages going up on a quarter on a YY basis as well. We understand that this is a quarter when we normally see agri loans, slipping into NPAs. But other than that, is there any other systemic issue which is being seen in these banks or other areas of concern which is actually leading to increasing provision and slippages for these companies and they are actually on the back foot?
Absolutely. So if you look at ICICI Bank's retail growth, you will find that the retail growth has been slowed down this quarter. HDFC Bank's retail growth has also been slowed down. Unsecured side of the book is a challenge for all banks. Most of the banks are facing a challenge there. NPAs are surging there. Particularly if you look at the smaller banks, Bandhan, for example, has seen a huge surge in the slippages this quarter. That is simply because they go and lend to unsecured side of it. So does RBL, so does to some extent HDB Financial as well. So that is one cause of concern for almost all of the banks per se. From my perspective, all large banks maintain a mix of secured and unsecured, and I don't think they would have a problem maintaining asset quality. They will be the one who will be the least scathed. Over the balance of this year, large banks will continue to do well, provide stable returns to investors, stable business performance, whereas smaller banks continue to take the beating. At the same time, when smaller banks continue to take the beating, their shares, stock prices will start to become attractive as they trade near about a price to book value of 1.5, and that's where the real delta over the period of next 2 to 3 years really is. So it's a balance between stable investments in the larger banks, delta for the next 2 to 3 years for the smaller banks. You have to be really very careful. You have to invest in banks where you think the banks will sustain themselves and not go bad. And also, you have to balance between growth and NPs.
Right, that's a view coming in for banking sector, but I also want to shift focus to NBFC sector. And Shweta, we have seen few earnings so far. L&T Finance is one of them. Their healthy profit growth has been witnessed, profit of around 701 crore. Disbursements were also up around 18% if I remember the number correctly. I want to understand from you, do you see a kind of divergence between banking sector and NBFC sector, or you see the same problems continuing there as well?
Yes, good afternoon. So NBFCs have always reported slightly higher growth across the past a decade vis-a-vis banks. Coming particularly to the name you mentioned, L&T Finance, definitely it was a good quarter. But we have to also come to the terms to the fact that diversified product profiles are what leading these NBFCs to put up a stable, steady kind of better growth. Particularly on the L&T finance side, two to three things have worked in their favor this particular quarter. And firstly, the focus on prime customer base vis-a-vis say an HDB Financial Services customer profile, which focuses on lower strata of the society. So that's one. Second, their diversification and latest acquisition on gold loan side. So larger part of disbursements growth this particular quarter has been driven by gold loan traction. And last but not the least, like I mentioned, because it's a diversified product franchise and they have been early on in implementation of tech initiatives. So all these points put together, this has led to slightly stronger growth for the company. We definitely perceive growth will be slightly better for NBFCs than banks, and this will sustain for another 2 years or so. But in current scheme of things, and with the expectation of another 25 bips rate cut, maybe in the August policy, I think NBFCs will continue to remain in favor.
So NBFCs will remain in flavor going ahead, especially as compared to banks. They have been outperforming banks since a long time. But yes, there are issues within NBFC sector as well. There are some pockets which are actually facing pressure, and we spoke to the management of L&T Finance. Let's first listen in.
Probably we should have much stronger growth this year. One of the things which probably has sort of delayed the recovery slightly is that the Karnataka ordinance, and Karnataka is a large market for us. Obviously, there we saw a little bit of cessation of collections performance for a brief period of a couple of months. And after that, the collection efficiencies have started inching up. But we are being cautious in Karnataka, and our disbursement momentum in Karnataka has not picked up to that extent that we would like it. So overall, if you see, the majority of the stress pool addition has been from the rural business finance and a little bit from the two-wheeler and the personal loan segment. However, over the last year, we continually fine-tuned our credit policies as well as our onboarding criteria and implemented Project Cyclops, which is probably the industry's first integrated three-dimensional sort of AI credit engine. And the initial impacts on the two-wheeler business has been extremely good. And we have seen excellent results.
So definitely concerns remains in Karnataka as far as collection efficiency is concerned. But Shweta, I want to ask you about the vehicle financing. How is that faring? What is the on-ground assessment which you might have done?
Yes, so vehicle finance continues to reel under pressures, and HDB Financial Services data on the CV side definitely corroborates this negative stance. Also, our on-ground channel checks definitely indicate cash flow issues, especially in the earn and pay segment, in the driver come owner segment on the CV side. Also, we have to come to the terms to the fact that Q1 traditionally is a seasonally weak quarter for NBFCs, especially CV financiers, because they are headed into peak of monsoon season, so where collection activities get impacted, trip activities get impacted. But definitely there have been also resale price issues on the used vehicle financing side. New vehicle demand continues to remain subdued. So net maybe at least till festive season picks up and peak of monsoons are behind, CV financing challenges will sustain. Also, we are coming from an up cycle of 3 years. So definitely this cycle on the downside might be stretching till end of FY26.
So that's the view on vehicle finance. But Shweta, just wanted to understand your views on the net interest margins for NBFCs, because we have seen in this quarter for L&T Finance the overall net interest margin has actually risen from 10.15% to 10.22%, including the fees. So what's your view on the overall net interest margin for the NBFC sector? And there is one sector, that is the gold financing sector. It is expected, it is estimated that is one of the safest sector, and the overall net interest margins over there are the highest. So what are your views on gold financing companies as well?
Yes, so NBFC's margin uptick will largely come through in second half of this fiscal, because apparently most of the NBFCs will see repricing of their high cost liabilities only in second half coming through. Also, we have to be cognizant of the fact that while they are benefiting from the banks on their portfolios, they have to pass it on through lower yields as well, which will also sort of pressurize their margins a bit. So net, larger part of margin benefits will happen in second half of this fiscal. On gold loans in particular, so considering the demand scenario has remained pretty strong, also considering the fact that microfinance credit line has been choked. So again, that is a further boost to the gold loan demand. So even at higher interest rates for likes of Muthoot and Manappuram, gold loan traction continues to remain robust. So yes, we will continue to see slightly higher margins and better growth prospects on the gold financier side.
All right, coming to you, Aditya, for banking earnings, so far PSU banks, if you talk about earnings performance is separate and stock performance is separate, at least PSU pack has performed well. But in terms of earnings, we had very few names so far. Central Bank of India has posted earnings, Union Bank of India has posted earnings. Uh, Compared with private peers, they have at least posted better margins, and even asset quality has been slightly better. So what is it you're picking up as far as PSU space is concerned?
So from my perspective, margins this quarter are meaningless and will continue to remain meaningless until the rate cut cycle stabilizes. So from my perspective, you'll see the rate cut, the margins move up and down over the period of next 2 to 4 quarters. It doesn't really have any bearing on the in the longer term. Yes, provisions and slippages for both Union Bank and Central Bank have come down. The bank managements have guided that they will strive to make sure that these provisions continue to remain lower. But I think most of the PSU banks are priced to perfection. I think they will remain below book value until markedly sees that the managements of these companies have really changed. So from my perspective, if you want to stick to a PSU bank, I would rather stick to a State Bank of India, or for that matter, or to a Canara Bank or a Bank of India. I think a State Bank of India's results this quarter would be really very good. I think their slippages would be arrested with a good loan coach in that case. So from my perspective, rather than going to a smaller PSU bank, I would stick to a larger PSU bank such as SBI, BOB, or Canara.
I just wanted to understand your views on AU Small Finance Bank, because the stock is down in today's trading session after the results. The overall gross NPS, they have actually risen. Does this in any way impact the universal license for AU Small Finance Bank, and also how do you see it for other small finance bank if this is the way that the NPS increase and the net interest margins go down?
So this is a cycle that is playing out, cycle of microfinance lending, microfinance lenders bearing the brunt. There's not even one microfinance lender out there who is not facing a challenge with respect to NPS. So from my perspective, this is nothing new. The rise in gross NPS is because they are lending to the riskiest class of the society, and as that class of society faces a severe challenge, obviously the likes of Bandhan, RBL, AU, all of these would face a severe one. I don't think this has a material impact on their universal banking license, or for that matter, any smaller bank, let's say, for example, Ujjivan converting into a universal bank. I don't think that has a material impact. The RBI always sees for any misgivings or any frauds that are happening within the bank. I don't think that that's the case really. What is really happening there is the cycle has turned out to be bad, and a lot of these banks are facing those challenges. I'm not surprised that AU Small Finance Bank has fallen today, and I think the cycle will start to improve only by the second half or by the end of this year, not before that. And as I said, as the valuations for many of these banks, not particularly AU, start to turn attractive, they could be an interesting opportunity for long-term investors.
Adit and Shweta, thank you so much for joining at this hour and presenting your views. As far as this quarter is concerned, the full picture of earnings is still to be out, so scorecard is still open and we'll wait for that. With this, it's time for a wrap in this special edition of Banking Earnings Show. From me and Varun, it's a goodbye.